How can tax implications strategically help in divorce asset division? Imagine turning a complicated puzzle into a clear picture. That's what understanding tax implications can do for dividing assets during a divorce. It's not just about splitting things equally. It's about doing it smartly to keep more money in your pocket. When you're going through a divorce, you might focus on who gets what, but overlooking tax effects can lead to surprises later. Knowing how different assets are taxed helps you plan better. For example, investment accounts often have unrealized capital gains, which means the increase in value since you bought them has not been taxed yet. When these are transferred in a divorce, the person receiving the assets inherits the original purchase price, called the cost basis. If the asset has gone up a lot in value, selling it later could mean paying a big capital gains tax. That can cut into what you thought was a fair division. Real estate, especially the family home, has its own tax rules. If the home was your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of capital gains from taxes if you are single, or $500,000 if you are married filing jointly. Timing the transfer of the home to take advantage of this exclusion can save thousands of dollars in taxes. Retirement accounts like 401ks and individual retirement accounts are tax deferred. This means taxes are paid when you withdraw the money, not when you transfer it. Using a qualified domestic relations order allows these accounts to be divided without triggering immediate taxes or penalties. Transferring assets directly, instead of selling and then dividing, can also help avoid paying taxes right away. For example, transferring shares of stock keeps the original cost basis intact, which can lower taxes when you sell later. Sometimes waiting to sell assets until tax rates are lower can save money. When negotiating, consider the tax burden of each asset. If one person gets assets with high unrealized gains, they might need to give up other assets to balance things out. Accepting assets with high tax liabilities without accounting for the future costs can lead to unfair outcomes. Working with financial and tax professionals is a smart move. They can help you create a plan that minimizes taxes and aligns with your financial goals. Avoid common mistakes like ignoring the cost basis of investments, mishandling the transfer of the family home, or dividing retirement accounts without proper legal documents. These errors can result in unexpected tax bills or penalties. By thinking about taxes during the division process, you can protect your financial interests and make sure the settlement is fair and efficient.